Do we like writing on my t-shirt, or am I best to go? Oh, this
I
way
like
I
that
both
way.
think,
ways.
yes, if I have
Like
a
the
vote,
writing.
I think you should go topless, but that's just me. Hello, everybody, and welcome to another Finimize Analyst Roundup. We are very excited for what we have in store for you today. So, as usual, we're going to go over three main things. First of all, I shall provide a very quick update on the latest performance of the Finimize Analyst research ideas. Second of all, we will go through the biggest research pieces that we put out there per analyst, and we really have some exciting things for you this month, or should I say last month. And then third of all, we shall answer all your questions. So thank you once again to everyone who submitted their questions, and we'll try to get through as many of them as possible. So first of all is the quick performance update. So since we basically launched the Finimize research ideas in October 2024, our investment ideas have delivered an average annualized return of 44%, beaten their benchmarks on an annualized basis by 19 percentage points, and have made money on 74% of the calls. So some great performance stats there, and I couldn't be prouder of the analyst team we have right here in front of you. Second of all, so just on our research over the past month, and honestly, I'm again once again very proud of the team, because our latest research last month is a great example of how we stay ahead of the biggest trends. So we put out three main research pieces. The first one is 8 stocks to watch if the Strait of Hormuz reopens. We all know the war in the Middle East is the biggest macro theme this year, so we're on top of that. I put out a piece on should you invest in SpaceX's IPO. SpaceX's IPO is probably the most hotly anticipated IPO this year, probably on par with OpenAI and Anthropic. So we've covered that. And then Theodora did a piece basically on a very interesting cable stock that's at the intersection between AI and power, two very dominant themes in markets today, as we all know. So what we want to do is just provide a very, very quick overview of each. Again, if you're interested in the research pieces, you can read or listen to them on the Finimize app, on web, or on Substack. So SpaceX, very, very fascinating company. It's a huge piece, a lot to talk about, and I'm not going to go to all the details just for the sake of time, but I'll give you the high level overview. So what is SpaceX today? SpaceX today is really three businesses bolted together. You've got a launch operation that dominates access to space. You've got a satellite internet service called Starlink that has become the cash cow of the company. And then you've got an AI lab that includes Grok, the LLM Grok, the chatbot, and the social media platform X. And the AI division is the cash burner at the moment. Key details of the IPO. So SpaceX is looking to raise $75 billion at a $1.8 trillion valuation, roughly. And the targeted date is Friday, the 12th of June. So in around a week or so. Now, in the research piece, I discussed 5 reasons to invest and 5 reasons not to invest. And I did a valuation and I gave my take at the end. So high level summary, 5 reasons to invest. First of all, if you strip away the AI division, the core SpaceX business is one of the strongest operating stories on the planet. It dominates 2 big growing markets, which is basically launch and satellite-based internet connectivity, and its lead keeps on widening. Second of all, SpaceX has more credible growth paths than almost any other businesses of its size. Third of all, it is the cleanest way to play the AI data centers in space theme, something I've talked a lot about in the past. Fourth, you've got the Elon Musk premium. So we all know Elon Musk has a very, very strong, loyal fan base. And actually, if you look historically, people who have backed his companies and his crazy visions have actually ended up, making a lot of money. And that same playbook could apply over here. And the fifth and final reason, which is probably maybe the biggest reason, is passive and ETF money flows. So the NASDAQ has already changed its rules to allow fast entry to its indices. The S&P 500 is considering the same. The FTSE Russell has already done so, et cetera, et cetera. And long story short, what you're going to see happening is a lot of passive money flow. So a lot of ETFs that track the NASDAQ, S&P 500, index funds that do the same, et cetera, will be forced to buy SpaceX stock, will be chasing a limited amount of SpaceX stock because, I said $75 billion being sold on a roughly $2 trillion valuation. That's a very, very small percentage free float. And on top of all of that, you have a lot of space-based ETFs already out there. You have about 10 filed or launched in the past 3 months, and they're all going to be chasing the stock as well. So you have a lot of this forced buying from index funds, ETFs, and so on into the stock that could ultimately give it a short-term boost. Now, 5 reasons not to invest. The first one is governance and key man risk. So I talked about Elon Musk being, he's got this premium, but it swings both ways. At the same time, he's going to retain complete control of SpaceX even after the IPO. And, should things go wrong or people or shareholders are not, satisfied with the way he's running the company, tough luck. There's absolutely nothing you can do about it. He will remain in the company and he gets the final say on pretty much every matters. Second of all, after the xAI acquisition, SpaceX is no longer a pure play space company. So it's really trying to pitch itself in its IPO as an AI company. Actually, if you look at the IPO prospectus, it identified a total addressable market of about $28.5 trillion. For context, that's almost the size of the entire US economy. And out of that $28.5 trillion, it said 93% of that addressable market is purely tied to AI. So long story short, it's really trying to pitch itself as an AI company, which is probably what some investors don't want to see who thought they were buying a pure play space company. Third of all, there's a lot of risks around execution. It's, in development, big heavy rocket called Starship is the single biggest variable. So SpaceX's entire pitch around cheaper launches, cheaper Starlink deployments, moon missions, reaching Mars, you name it, data centers in space, etc., are all based on Starship working successfully. And right now, that's not the case. It's still in development, and it's had several test failures over the past sort of few years. Fourth of all, hate to break it to you, most IPOs end up disappointing in the long run. So if you look at the historical precedent, IPOs are usually not the best long-term investments. And then the fifth and final reasons not to invest, and this is really the big elephant in the room, is the valuation. Okay, $2 trillion. If you look at its revenue last year, it's hitting the market at 100 times revenue. For context, the median NASDAQ 100 stock trades at roughly 6 times market value to sales. SpaceX is going at 100 times. So you can kind of do the math. Now, in terms of my own valuation of the stock, I won't get into the details. Long story short, hey, I do arrive at $2 trillion. That's the good news. But at the end of 2034, discounted back to today, it's $1 trillion, roughly half of what Elon Musk is seeking. And also I factor in a lot of, positive executions in my model. I assume Starship ends up working and so on and so on. So what's my take with all of that? My honest view is that, look, SpaceX appears most probably overvalued, but the market acts in a weird way. And actually, I do think the stock will probably perform well in the short run after its IPO, just because of all the reasons I mentioned. So the loyal Musk fan base, all the passive money chasing the stock, and so on and so on. So if you are lucky enough to actually manage to get an allocation at the IPO price, then I think it's probably worth, having a shot at it, but just keeping it a very small part of your portfolio. So don't YOLO all your life savings into the IPO. Have a small portion of your portfolio, and if you can get in at the IPO price, that's really good, as opposed to trying to chase the first day pop, which I expect to happen. Yeah, and the reason why I say, keep it a small slice of your portfolio, because of that valuation, okay? The valuation is super high, and that basically leaves very, very little room for mistakes. Now, I'm going to do a follow-up research piece that'll be out a few days before the IPO, so please look out for that. Now, without further ado, I'll hand over to Theodora on a company that's working on, related to AI, but more in Earth as opposed to in space.
Great, thank you, Reda. So my latest drop is on Pressman. And honestly, as I was looking through my 2 portfolios, which is AI and the power grid, I actually think it's one of the more interesting ways to play 2 of the biggest investment themes right now. So as you can see from some of our end of month research report, that both my data center and global power grid portfolios have both had a really strong run this year so far. what we've seen is that demand has been huge. Companies have been raising forecast, and order books are actually filling up very fast. So obviously, like the easy money is there. Investors have made lots of money from the obvious winners. So what I was trying to do with this piece is to go back through those portfolios and look for the companies that I find are still genuinely important. The ones that are strategically well placed, maybe still somewhat underappreciated, and at least worth a closer look. And Pressman is interesting because it sits right where both those two themes overlap. It's also a European company. So as we have seen, the US companies have really done well. Europe have caught up, but not to the level where US AI exposed companies are at. So a little bit about Pressman. At the most basic level, you can say that Pressman is the world's biggest maker of energy and telecom cables. So what they do is they make the physical infrastructure that moves electricity and data around our modern economy. And so that would include everything from the low voltage wiring in buildings and data centers to the huge high voltage submarine cables that connect your offshore wind farms, your islands, your countries, and your power grids. So very basic to very highly technical stuff. What really stands out is its transmission business. So what they do in this segment is that it deals with those big high voltage and submarine cable projects I was just talking about. And last year they ended the year with a record 16 billion euros order backlog, plus another 3 billion of identified pipeline, which is kind of a soft backlog. And that's roughly, giving it 5 years of revenue visibility in a segment. And in a cyclical industry like theirs, that is actually pretty rare. So what we can see is that the numbers are already moving in the right direction. Transmission margins in the division have actually hit their 2028 target 3 years early. So what that means is that the operational leverage of the business is actually pretty high. Another division of their digital solutions, their margins have also jumped above the 2028 target. So what I'll say is that the story is more about demand. It's also about Pressman potentially becoming a better, more profitable business as its whole business mix just shifts towards higher value work. And then obviously the next question is, where is valuation? So yes, I'll acknowledge the stock has already had a big run, but based on my DCF model and peer multiple comparison, I still see about 30% upside if the market starts valuing Pressman more like the other high quality electrical infrastructure names, particularly those in the US. The risk that you need to be aware of is that the projects they're dealing with is massive. So obviously we're talking about execution risk, cost overruns, potentially more industry capacity coming in, particularly in areas in emerging markets. So Chinese competition is one. And then there could be political interference in energy infrastructure. So I would say it's a really nice name to have, but it's not risk-free. But it is, if you want to consider a solid company that's sitting in the intersection of both AI and the power grid build out, which would take decades, Pressman is a seriously compelling place to look. But this is not the only idea we have. I know Russell's got another interesting trade basket to talk about as well. Russell, over to you.
Thanks, Theodora. Nothing better than an AI basket and AI exposure in these markets. So my idea is more about what can happen next, and the Strait of Hormuz being closed. We've seen oil prices sort of like hike up, interest rate expectations increase, inflationary pressures, costs going up for businesses, interest rate sectors have been down. Companies that use huge sort of amounts of fuel, whether it's airlines or cruise ships, have been hit hard. So across the board, outside of AI, under the surface, despite markets kind of getting to new highs, there's a lot of stocks that have been struggling, especially since the end of February when this Iran conflict broke out. So what I tried to do when I was screening, I was looking for companies which have performed well, up positive territory year to date come the end of February, because that kind of implied that the market or investors quite like these companies. And then since then, as we know, many companies have been hit hard. So I went through a list, used some regression analysis to look for the negative correlation with the oil price. Basically, I went through and found 8 companies across a variety of sectors which look well positioned for a rebound when trade, Hormuz reopens, oil price comes down, and interest rate expectations kind of lower again. So it's a combination of everything. I think it's important to know was more a watch list, and I started with a half-size position initially because at the end of the day, we seem to getting closer to like a conflict resolution, but then there's a new headline that says we're not. And so anyway, that's where we are. So the 8 names that sort of like made the cut, which all meet that criteria, were Carnival, Smurfit Westrock, Martin Marietta Materials, Toyota Motor, Lennar, Reckitt Benckiser, Southwest Airlines, and Carrera Electric Power. It's a select group of 8 companies across a broad range. I think that if you're only looking for 2 names, arguably 2 of the ones that I'd sort of said that look the safest plays within that would be Southwest Airlines, just because of the oil price or the fuel price, which is up, and Lennar on the interest rates. Those 2 companies were the strongest before the conflict broke out. So by default, arguably, they may be, based on the type of analysis I was doing, the 2 strongest posts. But anyway, those are like the 8 names, and I'm waiting for a full reopening of the Straits of Hormuz before kind of upping to a full size. I do think that there's a lot of opportunities out there when, the world normalizes, inflation and interest rates come, head back lower again. So I think there's more than those 8 companies there, but there's definitely the ones that I'm starting with. But for sure, if the world normalizes, there's probably a lot more companies that you can think about adding sort of, as time goes on. I do think I just want to mention a couple of things on the AI trade because it's such an important one. And there's 2 ideas in the portfolio that are worth mentioning. And I did write sort of like updates on them sort of over the month is the memory stocks in Korea, where valuations are still exceptionally low, 7 times PE for trillion-dollar market cap companies. That's for SK Hynix and Samsung Electronics, and they make up more than 50% of the Korea ETF. And gradually the market is pricing in the longer demand and pricing for memory. Now analysts on the street, Goldman Sachs at the weekend, just up their numbers for 2027 and 2028 for pricing and demand, and obviously estimates. And I do think that the valuations of these companies and therefore Korea look sort of way too cheap, sort of taking all this into account. To have trillion-dollar market cap companies trading at 7 times PE, kind of current, if the cycle's going to be stronger for longer because of AI demand, it just looks absurd. If you really look out, and they are going to have to spend sort of like money on expanding production. SK Hynix announced something today on that thing that they're going to sort of increase memory production. But they're going to have like currently about 40% of their market cap's going to be net cash 2 years out. So really, you could be looking at sub 4, sub 5 times, potentially closer to 3 times net cash PE ratios. And they just look kind of absurdly cheap still, despite the 100% rally for the Korea ETF and way more than that for those underlying stocks.
Awesome. Fascinating. Thank you so much, Theodora and Russell. Really, really fascinating research. Awesome. So with that, we'll move to the questions that we received. Once again, thank you everyone for the questions that we got. So I'll kick off with a 3-part question that we got from Mohammed. So as to the first question, what are the best ETFs to invest in now? In my opinion, there's no such thing as a best ETF per se. I think the better question to first ask yourself is, what is the best asset allocation for me, given my unique circumstances? And then once you determine that, then you can go about selecting the best ETF for the asset classes that you have determined. So I think the first question to ask yourself before saying, hey, what's the best ETF, is you need to figure out what's your asset allocation in your portfolio. How much will you be putting in stocks, in bonds, in commodities, in gold, in crypto, in real estate? You name it, you name it. And that is a function of your own personal circumstances. What's your time horizon? What's your liquidity constraints? And that determines your ability to take risk. How much risk you can take determines how much return you should be targeting with your portfolio. And then based off that, then you can determine your asset allocation. So hypothetically, if you have a strong ability to take risk, you can target a higher return, then your portfolio will naturally be weighted more towards things like stocks. If the inverse is true, then your portfolio will be probably weighted more towards things like, low duration bonds, for example. So once you determine how you want to split your portfolio across different asset classes, then you go about selecting what you think is the best ETF for each asset class exposure. And when you're looking to select an ETF, things to look out for is obviously keep expenses low. So try to pick the ones that have the lowest fees. Make sure you pick ETFs that are highly liquid, so they're very big. They trade frequently. That way you can invest in and out without too much trouble, essentially. And then look for things that give you proper replication. So, for example, if you're investing in something like, let's say crypto, there are different ways to do it, or futures, spot, actually owning the Bitcoin, or more esoteric ways of doing it. I would stick with the simple ways of just simply physically owning the underlying asset and simple replication. As to the second question, what is the future of Bitcoin, up or down? Honestly, who knows? I don't know. I don't think anyone knows. So, let's not forget, Bitcoin is very different to a stock, right? A stock is, gives the underlying ownership in a company. You can value it. If the company's prospects are looking bright, you can expect the stock price to go up. Bitcoin on its own is very hard to value. It's very hard to say if it's going to go up or not. Personally, I have a very, very tiny amount of my asset allocation in Bitcoin, and I overlay it with a trend filter. So basically, a simple mathematical rule based on moving averages to see if Bitcoin's trending up or down. When it's up, I'm invested in it. When it's trending down, which is the case today, I just take that tiny allocation out and I put it in cash. So that takes the guesswork out of it. So instead of me trying to guess, will Bitcoin go up or down, I just use a momentum signal to make that decision for me. But the most important thing is the allocation I have in my portfolio towards Bitcoin is very, very, very small. The bulk of my portfolio is in stocks, bonds, commodities, gold, and more traditional asset classes. As to your third and final question on Wealthsimple, the honest answer is I'm not familiar with that platform. I think it's based in Canada, which is not where I am. And I'd rather tell you I don't know anything about it than to give you a BS answer, to be quite honest. So I'm really sorry. I don't know much about Wealthsimple.
Yeah, so good points, Reda. And I see that Nabil also had quite a similar type question regarding what are the best ETFs to buy in the current market conditions. So yeah, completely agree with Reda. So the way I'm going to interpret this question is in a way of what 3 ETFs might be kind of nice to have. Obviously, you need to pay attention to how your portfolio is allocated and your risk tolerance. But I can kind of recommend what are my favorite 3 that I'm kind of looking at. Yeah, so the kind of 3 things I think that we should be aware of in the current market conditions is that inflation could be a lot stickier than we expect. Tech could continue to be super strong. And also there could be a continued rotation towards cheaper cash generative companies. So we've seen emerging markets really do very well in this environment. So one of my top 3 picks that I kind of like, which I think people are kind of overlooking, would be the Invesco Optimum Yield Diversified Commodity Strategy ETF. It goes by the ticker PDBC. So I really like this one because it focuses a lot on real assets, which means it gives you broad exposure to commodity futures across energy, metals, and agriculture. And the rationale is that if inflation does surprise higher again, commodities is actually one of the few parts of the markets that can benefit directly. It's not a perfect hedge because futures-based commodity funds are a bit more complicated and they are affected by roll, cost, and volatility. But it does give the portfolio something that can perform if you think that both stocks and bonds are going to be under pressure. Then the second one, I mentioned this before, I really like the Pacer Cash Cows ETF series. The one I'm looking at is the Pacer Emerging Markets Cash Cows 100 ETF, and the ticker goes by ECOW. So this gives me a little bit more of emerging market exposure, but with a quality and value filter. So rather than just buying the whole emerging market index, this one actually screens for companies with very high free cash flow yield. And I think that's actually really important because cash generative companies are generally less dependent on cheap financing. And they can be better placed in a higher rate or inflationary environment. So it gives you, if if you're buying into the S&P 500, you're already heavily weighted to US mega cap tech. This gives you a more value tilt. And it also gives you some indirect exposure to commodity-linked economies and sectors. And then my last one will be, I definitely do still want to have some tech exposure. And so the Invesco QQQ Trust, very popular, goes by the ticker QQQ. This is the growth engine. It's done very well. It tracks the NASDAQ 100, but also heavily exposed to large US tech companies and the AI infrastructure build out. If anything, I would say your portfolio is probably already exposed to this. And this is probably the most vulnerable of the three if inflation stays sticky and rate cuts are delayed, because long duration growth stocks like tech names, they tend to be very sensitive to real rates. So the three are kind of the ones I kind of have my eye on in terms of my favorite. I also quite like Russell's recommendation of the South Korea ETF. So that's probably something you want to explore too.
So, Alessandro, thanks very much for the question. I'm a bit of a fan of technical analysis, so this one's kind of up my street, as they say. And I use many of those indicators myself when looking at stocks, ideas, indexes. And I've actually written a few insights discussing sort of some of those, whether it's the moving averages and the MACD. Using technical analysis and rules sort of just helps investing and can take some of the emotion out of the decision-making process. But still, it's important to always remember that no system is perfect, but the combination that you're using, the MACD moving averages, whether the simple or the exponential ones, make sense. And they are some of my go-to. I kind of maybe add to that, maybe trend lines. They're also useful, but that mix of moving averages you're using probably kind of factors those in. But sometimes in between the lines, between those moving averages, those trend lines may show up, and that can sort of maybe help why sometimes whatever you're looking at kind of gets stuck or rebounds sort of, or, finds resistance sort of in between those levels. It's important to know that MACD or any technical indicator has limitations. Sometimes specifically for the MACD, if you wait for the signal for the actual buy or sell signal from it, it means the underlying assets already moved sort of quite, somewhat beforehand. So sometimes it's good to try to anticipate when that, a few days ahead of that time and sort of step in. But it's also important to remember that that's turning it into more of an art, not a science. So you have to be very careful, because sometimes you'll find that you're wrong, and then, you need to cut quickly if you try to sort of anticipate ahead of the game as such. So I think it comes back to a rules-based system. The only extra one that I'd put on there from the momentum side, and it would already tie in, because by default, if a stock's making a new 52-week high or 52-week low, it's going to already be above or below those moving averages that you use. But I do find it's quite a good place for finding momentum ideas. But overall, look, you can use a whole variety of indicators, but the more you use, it can get really complicated to kind of keep a track of all of them. So really, using 2, 3, 4, whatever you're comfortable with of different types of indicators can be one approach that helps.
Yeah, so on this question, look, ultimately when SpaceX hits the market, and if you realistically are trying to build a space-based thematic basket, it's going to have to include SpaceX, right? One way or another. It's going to be the biggest space-related name by a wide margin. Having said that, I've already mentioned earlier on about the valuation, about the risks and so on. So I do think it's worth also exploring other names in the space industry. And actually, to get you started, there's an image over here by Morgan Stanley, which have basically put together a basket of 60 stocks related to the space economy. And actually, the whole space theme is gaining a lot of attention, a lot of investor attention these days. It's partly related to SpaceX's IPO, it's partly related that there's a lot of renewed interest in space. So we had the Artemis 2 mission to the moon, which was gathered a lot of interest. We had a lot of blockbuster space movies, Project Hail Mary, for example, and so on and so on. And there's just a lot of general interest in space, I would say, as a theme. And that naturally translates to a lot of investor interest being turbocharged by SpaceX's IPO. Having said that, also just watch out in the sense that when there's a lot of interest in a particular theme, and right now also what you find is a lot of ETF providers are trying to piggyback on that, and they're launching a lot of space-related ETFs. So like I mentioned, there's already 4 out there, and then 10 more have either filed or launched in the past few months alone. And usually, to me, that's like a little bit of a contrarian signal. And there's research by Morningstar actually that shows that thematic ETF investors historically underperform the very trends they chase. That's because they often buy after the excitement has already peaked, and then kind of sell into the weakness when things sort of mean revert. And if you remember, during the COVID era, we had similar ETF frenzies around renewable energy, around cannabis, and so on that didn't work out too well for investors. So just note that as a cautionary tale. So summary is, if you're interested in investing in space as a theme, it is super fascinating. Just know that the whole sector, especially this year, has already done really well. Valuations are overstretched. So any allocation you put into the theme, into the basket, please keep it small. Second thing is, yes, it's not all about SpaceX. That Morgan Stanley basket of 60 stocks is a good place to start looking for individual names. You can look at particular companies that supply components to SpaceX. You can look at companies that produce the necessary jet fuel used in rockets, for example. And you can look at companies that stand to benefit from increased satellite constellations and so on and so on. So there are many different ways to play the theme. And honestly, I try to be a bit disciplined around value in this particular case, because like I said, a lot of the names in the sector are trading at very sky high valuations, no pun intended. And yeah, I'll just be quite cautious about that.
Okay, so we've got another question from Stig, and it's a really great question because, I get where your kind of concern is from, but I would kind of separate two things from your question. So first, the bond market and the stock market are kind of looking at different risks, right? What we have seen from the bond markets, what yields are saying is that they're implying that inflation may be stickier, rates may stay higher, and governments may need to borrow more. So that kind of reading would naturally put pressure on long duration assets like tech stocks, as you are so rightly concerned about. But stocks they do factor in these concerns, but there are things that are more important. So especially with tech, investors do want to be looking and are looking at earnings power and AI optionality. So investors are effectively saying, yes, rates are a problem, but if AI actually does become a major productivity and revenue driver, then actually the biggest tech companies that we have today may still go into today's valuations. So I think investors in the stock market tend to look a lot longer term. The important ones, I would say, and I want to correct you on that, is that the Mag 7 actually do have real ROIC, do have real good returns on invested capital in their core businesses. So if you're talking about Microsoft or Alphabet or Meta, they're generating huge returns from software, advertising, cloud devices and platforms. And this is very different from the dot-com era that we saw before. I think what is probably still a concern and what is still unproven is the return on the next wave of the AI capex that they're spending on today. So all the data centers, the chips, the energy, the infrastructure being built now. And I think that this can still likely continue for some time, probably as long as earnings still stay resilient. And as long as investors believe that AI spending will eventually translate into revenue, margins, or competitive advantage. And, the last earnings seasons that we have seen actually do show that, it's actually translating into top line and into the bottom line. So I think, if what might happen is, if AI spending stops, then a lot of this kind of merry-go-round can actually stop, can actually break. So in other words, I would say, long story short, this can actually go on longer than it feels comfortable or it seems kind of rational to us. But it does raise the bar, you're right, in that tech stocks don't just need a good story anymore. They will need to start proving that the AI build-out can earn its keep.
In the Strait of Hormuz sort of research drop, we asked sort of like Finimizers to come in with ideas of companies they thought should also or could also make that list. And one idea that came through was Sea Limited, that sort of margins have been hit by the increased logistic costs. So yeah, definitely that's a case. It's an example of a company whose business will improve when the Hormuz reopens. The one thing that I'd say that it didn't match the criteria was the stock was actually down year to date at the end of February. So on that one, it wouldn't make the cut on that. It's obviously struggling on other metrics right now. So that's definitely just something to sort of bear in mind. But for sure, it looks like, lower logistics prices will improve margins. So yes.
Awesome. Thank you so much, Russell, Theodora. Thank you so much, everyone, for tuning in and for everyone who sent the questions. Hope that was useful. And we'll catch you at the next one. Thank you, everyone.
Thank you.
Thank you, guys.